gold is the best performing asset class of 2016. It's also the best performing asset class of the 21st century. If you had a gold standard, it is to force governments and countries to do prudent things. As it is now, there's no standard, there's no anchor, there's no forcing mechanism, there's nothing. I've spoken to Ben Bernanke about this. I've spoken to the head of the IMF about it. And they both use the same word in my conversations with them to describe the state of the international monetary system. They say it's incoherent.
Attention hard asset investors. If you want to maximize your gold and silver holdings, consider owning businesses that own a massive amount of the metal, who will benefit the most as the world witnesses the mother of all gold rallies. With nearly 10 million ounces of gold resources through acquisition, this 50-cent stock has received a $2.65 price target from Cantor Fitzgerald. Learn more at crushthestreet.com/goldstock.
Hello, everyone, and welcome into crushthestreet.com. I'm joined with James Rickards. He's a New York Times bestseller. He's the editor of Strategic Intelligence, director of the James Rickards Project, and you might have read his books, The Death of Money, Currency Wars, and his latest book that is going to be released on April 5th, The New Case for Gold. James, thanks so much for coming on the show with me today.
Thank you, Ken. Glad to be on with you.
Let's start off with the book here. The title of the book is The New Case for Gold. And I just want to kind of kick things off here with what is new in the 21st century for a new case for gold? I mean, I'll put it to you this way. What is wrong with the old case?
Well, it's a great question, Ken, and there's nothing wrong with the old case, but there's some new things to say, and that's part of the reason I wrote the book. First of all, the title has a little bit of a backstory that the listeners might be interested in. It was 1971 when President Nixon ended the redemption of dollars for gold by U.S. trading partners, and in stages that led to the end of the Bretton Woods gold standard. And in 1980, only 9 years later, not that far after Nixon's suspension, Ronald Reagan was running for president, and the subject of going back to a gold standard was a very live political issue. It seems old and cold today, but at the time that was still kind of a hot issue. And when he was elected, the way President Reagan dealt with this is he appointed a commission, a high-level bipartisan blue ribbon commission to study a return to the gold standard. And that commission did its work and came back with a report where the majority of the commission voted not to go on a gold standard. And of course, that's what happened. But there was a vocal minority on the commission, and as is often the case, they were allowed to write a minority report. And that minority included Ron Paul, Lou Lehrman, a number of other distinguished Americans and advocates for gold. So the minority report came out, of course, arguing in favor of a gold standard, and it was a public document because it was a government commission. So an enterprising publisher that was a public document that anyone could use and put it in book form and published it as The Case for Gold. And among gold advocates and gold investors, it's sort of a cult classic. People remember that book very well and has a very compelling argument. So my book, The New Case for Gold, the title itself is a little bit of a tribute to that original 1981 book, The Case for Gold, so looking back a little bit. But specifically to your question, Ken, there are reasons to own gold that weren't even considered until very recently. And let me give you a specific example. Vladimir Putin in Russia, president of Russia, has a 6,000-member cyber brigade working day and night to attack, disrupt, delete, and erase digital financial records of all kinds, shut down exchanges, shut down banks, and wipe out your digital wealth. Now, occasionally I run into very wealthy individuals, some of them billionaires, and you say, well, tell me about it. And they'll say, well, I own stocks and I own bonds and I own this and that and, futures or other contracts. And I say, no, you don't. What you own are electrons. You have your wealth in digital form, but you're utterly dependent on the power grid, computer systems, and not having that hacked and erased. And if one of these cyber financial attacks, and it's not just Russia, it could come from China, North Korea, Syria, Iran, or elsewhere, wipes out your bank or brokerage account, and you have nothing. Maybe you get a paper statement from your broker once a month, but that's, good luck trying to reconstruct that when all these systems are down. So people are extremely vulnerable when they hold their wealth in digital form. What I recommend is about 10% of your investable assets in physical gold, tangible form. And of course, the great thing about gold is that it's, physical gold, that is, it's not digital. You can't hack it. You can't erase it. You can't make it go away. And Ken, when I talk about these things, people think, oh, well, that would never happen, or, it's something out of science fiction. It's not true. These things are happening every day. These attacks are taking place every day. Just last week, the country of Bangladesh, one of the poorest countries in the world, lost $100 million. It disappeared. And they had that money on deposit at the Federal Reserve Bank of New York. In other words, it's not as if this was a sovereign reserve position, $100 million. They didn't have the money at the Bank of Bangladesh or some other, off-the-run or no-name bank. It was deposited at the Federal Reserve Bank of New York, theoretically the safest bank in the world, and yet $100 million just disappeared. Now, it's under investigation. Obviously, there's some crime or hacking involved there, but that's exactly my point. These things are actually happening. And your digital wealth is vulnerable to a number of calamities, infrastructure, critical infrastructure failures, whether it's power grid, banking systems, cyber financial war, et cetera. So I'm not saying sell 100% and buy 100% gold. I think that's nonsense. You never want to go all in on anything. I am saying take 10% of your wealth, put it in physical gold, put it in a safe place, and that will be immune from power grid outages, exchange closures, digital asset seizures, and cyber financial warfare. So that's an argument in favor of gold that didn't exist in the 80s, 90s, or even the early 2000s. We weren't talking about cyber financial warfare 10, 15, 20 years ago. The internet didn't exist in its current form until about 1996. And so these are recent new reasons to own gold, in addition to all the old arguments. And I agree with you that the old arguments are powerful in and of themselves, but there are new reasons to own gold, and that's why I call my book The New Case for Gold.
So, James, does this new reason give any bullish momentum for gold? Is there anything about the new reasons that are just, that are likely to push gold higher? Or is it still the old reasons that give gold its viability for, hey, this is going to preserve your wealth? And I guess you're saying that gold will preserve your wealth because you'll physically own it. But what about the aspect of it going higher? Is there any new reasons for the case for it to, preserve your wealth and to go higher than where it is today?
Well, gold is the best performing asset class of 2016. It's also the best performing asset class of the 21st century. So gold is doing quite well. It's up almost 20% a year. Obviously, it's volatile. It fluctuates. I'm not saying it couldn't go down. But when we're talking about this, Ken, we're talking about the dollar price of gold. I don't really think of gold that way. I think of gold by weight. An ounce of gold, 100 ounces of gold, a kilo of gold, a ton of gold. That's how I think about gold. Now, yes, it has a dollar price in the market, but why would you privilege the dollar? Why would you make the dollar the measure of all things? It makes more sense to me to make a weight of gold the measure of all things, and then say, when the dollar price goes up, that means the dollar is actually getting weaker, because it takes more dollars to buy your ounce of gold. And then when the dollar price goes down, that means the dollar is getting stronger because you get more gold for your money. But yeah, I understand the dollar price of gold fluctuates, and I understand it's volatile. But to me, that's not a gold problem; that's a dollar problem. And so when you say what's going to happen to the dollar price of gold, what you're really saying is you're not really asking about gold; you're asking about the dollar. Is the dollar going to get stronger or weaker in the years ahead? Well, that's debatable, but my view is the dollar is going to get a lot weaker. Now, right now, certainly since 2011, of course, the dollar's been getting stronger, and that's by design because the Fed has been tightening. This has to do with the currency wars. That was the subject of my first book. But we're now at the point where the dollar is so strong, it's killing corporate earnings, it's killing U.S. exports, it's slowing down the U.S. economy. Janet Yellen referred to this in her speech to the Economic Club of New York 2 days ago. So we're probably at the outer limit of how strong the dollar can be without actually sinking the U.S. economy, which means that the dollar is probably going to get weaker, which means that the price of gold in dollars should go a lot higher.
Well, that leads me into my next thing that I did want to talk about, and that's gold as money. And we are told, and then the paradigm of gold from the mainstream is that gold can't be money. It doesn't serve well as money. And there's a bunch of arguments for this. So, the first one that I'd like you to talk about, and I know you'll tear apart these arguments is having a finite currency such as gold will cause deflation. And I guess, is deflation in an economy a real problem? And I guess we've been conditioned to go out and spend because the fear of rising prices is kind of part of the central bank policy to keep the economy moving. Your thoughts on this?
Well, yeah, I hear the argument all the time, and you're right. It's one of the first things that the gold bashers tell you, but it's simply not true. It's based on a bunch of false assumptions. So, for example, people who are anti-gold will say, look, gold mining output grows about 1.6% a year. That is correct. Global growth, it's volatile, but grows maybe 3-4% a year. So what they say is the gold supply does not grow fast enough to support the growth of world trade and commerce or global GDP, and that would have to mean lower prices, which is deflationary. That argument completely confuses three different things: mining output, official reserves, and private gold. There are about 180,000 tons of total gold. About 35,000 tons of that are official gold. When I say official gold, I'm talking about gold held by central banks, finance ministries, sovereign wealth funds, etc. And then there's mining output, which is about 2,000 tons a year, give or take. Now, when people say, mining output's only growing 1.6% a year, so what? That's irrelevant, because you can just buy the private gold. In other words, it's the official gold that supports the money supply, right? Because private gold does not support the money supply. That's just private wealth held in the form of gold. Could be jewelry, bars, coins, bullion, whatever. But private gold does not support the money supply. What supports the money supply is the official gold of 35,000 tons. If you want to expand the money supply, first of all, you can have discretionary monetary policy on a gold standard. The United States had this from 1913 to 1965. 1913 to 1968. The U.S. money supply could be 250% of the amount of gold that was held by the Federal Reserve related to the Treasury. So, for example, in the Great Depression, everyone said you couldn't expand the money supply because you didn't have enough gold. That's not true. The money supply never exceeded 100% of the gold in the Great Depression. You could have doubled the money supply in the Great Depression and still been on the gold standard and still be obeying the law. So the problem in the Great Depression wasn't the gold, it was discretionary monetary policy. The same thing is true today. If you had a gold standard, you could still grow the money supply by allowing the money supply to be immobile with gold, number one. Number two, you could just buy more gold. You could just print money and buy private gold to increase the official gold reserves to expand the money supply. And what does that have to do with mining? So when people say, the gold supply doesn't go fast enough, they're talking about mining output. The mining output's irrelevant. What you want to do is just use up market operations and buy private gold and put it in central banks and then expand the money supply. So the argument's completely false. I do hear it all the time, but it's nonsense.
So James, and what you're saying, there wouldn't be a pegged price for gold. Gold would have to free float, or else there would be
No, I'm not saying that. I'm saying you could have a pegged price, but if you needed to expand the money supply, you could just print money and buy some more gold at that price.
But if the money, and I'm just trying to wrap my mind around this, if the money supply is increasing and there's a pegged price, wouldn't there be a discrepancy in the real value of the gold?
Well, there may come a time when there were no sellers at the price, but that's a market signal that's telling you that you've inflated your currency. So that would require some structural adjustment. That's the whole point of the gold standard. If you had a gold standard, is to force governments and countries to do prudent things. As it is now, there's no standard, there's no anchor, there's no forcing mechanism, there's nothing. I've spoken to Ben Bernanke about this. I've spoken to the head of the IMF about it. And they both use the same word in my conversations with them to describe the state of the international monetary system. They say it's incoherent. But at least initially, up to a point, you could buy some gold. If people had confidence that you were going to do the right thing and maintain the value of the currency, they would happily sell you the gold. If they lacked that confidence, then they wouldn't sell you the gold, I agree, but that's a market signal telling you you've got the wrong policies, you've lost the confidence of your citizens.
So I guess, too, when it comes to the gold standard, if the gold supply, let's say, wasn't going up enough to meet the economic growth. Is deflation bad? Because we've been conditioned to accept we need such and such inflation each year, and the government needs that for tax increases, and people need that because if there is an inflation, they're worried about people not spending their money and it not circling. But isn't the fact that I need to put gas in my car today to get to work reason enough to fill my tank up regardless of the price falling tomorrow? And it's this paradigm that we've been conditioned to accept we need inflation for economic stimulus.
Well, look, inflation is good for government and deflation is good for people. So it's the government versus the people. But you have to ask yourself who's going to win. I mean, if the government controls the money supply, controls interest rates, controls fiscal policy, and controls tax policy, and if the government wants inflation and the people benefit from deflation, the government's not going to help the people, they're going to help the government. So you should expect inflation. Now, the problem lately is, I call this Mick Jagger economics. You know, the Rolling Stones had a song called "You Can't Always Get What You Want." In other words, just because the government wants inflation, and they certainly do, they've said so ad nauseum, it doesn't mean you automatically get the inflation, because behavior it dominates, and if people want to save and put the money in the bank and not spend it, or wait or defer purchases, then what can the government do to change that? And that's what this whole battle, the last 7 years with QE1, QE2, QE3, Operation Twist, forward guidance, currency wars. It's all about the government trying to get inflation and not being able to get it. But the government's not going to rest. They're just the other day, Janet Yellen, in her speech to the Economic Club of New York, made it very clear that she's now become a complete dove. They've taken interest rate hikes off the table for the immediate future. They may come back, but they said, we don't really care anymore about job creation and low unemployment. We don't believe that that's giving us the inflation we want, so we're just going to keep interest rates low until we see the actual inflation. Then we can react to it. But, the government's doing everything possible to get inflation, so why wouldn't you have some goal? I don't recommend all in, but I do recommend 10% as your inflation hedge. So I agree that deflation is good for citizens. Inflation is good for governments, but you're fighting the government. I think the government will win in the long run, even though it's taking longer than they thought. And at the end of the day, they'll get the inflation, and you'll be glad you have some gold.
Mm. So, Mr. Rickards, in conclusion, what is your prognosis going forward here? Looking at the economy, looking at the global markets, looking at global currencies in 2016, going out for the next couple years.
Well, I'm a global macro strategist. Obviously, I talk and think and write a lot about gold, but I do a lot of other things also. And my assessment of the state of the international monetary system is that it's heading for a collapse much greater than 2008. And I base that on a couple metrics. One, I use complexity theory that shows that risk, or the worst catastrophe that can take place in a complex dynamic system, is an exponential function of scale. Meaning, if you double or triple the size of the system, you don't double or triple the risk. You increase it by a factor of 10 or 100, as the case may be. So all of the too big to fail banks, remember 2008, all you heard about was too big to fail. Well, those 5 biggest banks in the United States today are bigger than they were in 2008. They own a larger percentage of the total banking assets in the country. The derivatives books are much bigger. So everything that was too big to fail in 2008 is bigger and riskier today. And given the exponential function I described, that means that we're set up for financial panic much worse than what's happened in 2008. And I hear this, it's my own assessment, but I hear it from official voices and power elite voices, at the BIS, Bank for International Settlements, G20, IMF. Not so much from the Federal Reserve, but you do hear it from a lot of experts in a lot of different venues. So you can see this collapse coming, and then the question is, what's the response function? In 2008, the Federal Reserve set out on a path to print $4 trillion and do $10 trillion of swap lines with foreign central banks to bail out the banking system and paper over the last crisis. The problem is they haven't normalized their balance sheet. All that money is still out there. So when this next crisis hits, which is just a matter of time, and probably not very much time, what's the Fed going to do? Print another $4 trillion, another $4 trillion after that, take the balance sheet to $8 trillion, $12 trillion. At that point, you are probably past the outer limits of the confidence boundary, and they're really not going to be able to do it. And so the only clean balance sheet left in the world will be the IMF, which can print world money called the special drawing right of the SDR. So when that happens, that is definitely going to be inflationary. And so you can see the crack up coming. It's going to be worse than 2008. The response is not only going to be this massive SDR bailout, but it's also going to be draconian, shutting down money market funds, shutting down banks, limiting cash withdrawals from ATMs, closing stock exchanges, doing extreme things to try to contain the panic. And at that point, I would see gold at $10,000 an ounce, perhaps higher.
James, I have to follow up this with a question. And my question is, the people that are in power, the people who are at the central banks, Ben Bernanke, now it's Janet Yellen. I mean, do they see this happening, and are they acknowledging these problems in private and just putting on a front for everyone else to just instill some confidence globally for the masses?
Some do and some don't. I've spoken to Bernanke about it. I didn't. He's a smart guy, obviously. I did not get the sense that he really sees the extreme outcomes that I just described. But that's not a surprise. He didn't see 2007. I mean, in 2007, after the mortgage market crashed, he said publicly, this will blow over. Well, of course, he was completely wrong. They didn't see the mortgage collapse coming. They didn't see the panic of 2008 coming. When it did come, they reacted slowly, and when they reacted, they were insufficient. So the Fed has sort of blundered through every one of these crises. So I don't really have any confidence in the Fed's ability. I don't think Janet Yellen sees it coming either. But there are other power elite thought leaders. Again, at the places I mentioned, you look at some of the G20 reports. Look at Claudio Barrio at the Bank for International Settlements. The Rajan, the governor of the Central Bank of India, Larry Summers at Harvard. I mean, these are real insiders. These are members of what I call the power elite. But I mean, they're real people. It's not a deep, dark conspiracy. You know who they are. And they and others are putting out a lot of research and a lot of warning that this kind of collapse is coming. So I would say some of the elites see it, some don't. Of course, that's dangerous because the ones who don't are mostly at the Fed, and they're kind of running the world monetary system right now.
Well, there you have it, everyone. That's James Rickards. His new book, The New Case for Gold, is going to be released on April 5th. Be sure to pick one up. James Rickards, thank you so much for coming on the show with us today.
Thank you, Ken.